And joining us now for our regular Friday night chat is economics correspondent Stephen Long. Stephen, we just heard about Japan's debt woes, a sign of the times?
Very much so, Lee. Europe is having to go down the same route as Japan and massively cut government spending and sack public servants, cut their wages. And really there are a lot of parallels between what happened in Japan, where you had the bursting of a huge asset price bubble, particularly in the housing market, and then you had a lost decade of economic growth. Europe could well be in for the same. You could say it's got a touch of the vapours turning Japanese.
Back home, executives from the collapsed broker Sonray Capital have been told not to leave the country. How's it looking for clients who had their money with Sonray?
Very bad. The situation is that there is close to $50 million which has gone missing from clients' accounts that's been lost. And you'll have a situation where there are about 3,000 people who had accounts with Sonray. It looks like they will get back, at best, on the initial estimates, about 30 cents in the dollar. Now, there are some people who had their retirement savings in those accounts, tens of thousands, hundreds of thousands of dollars. The only upside to this, Lee, is that it's highlighted the high risks involved in the form of gambling that is known as trading contracts for difference, or CFDs.
So what are they exactly? Just decode that for us.
Well, CFDs, which Sonray, amongst others, was involved in, they're what's known in the finance jargon as a leveraged derivative. Now, derivative means that you're taking a position in a stock, for example, but you're not buying that stock or share. What you're doing is taking a bet that it will rise or fall in value, and you're buying exposure to the movement in the price. And the leverage is that you only have to put up a small amount of money. You effectively borrow the rest. So you might typically, with a CFD, put up 5% of the value of the position. So you're in effect getting a 95% loan, 20 times leverage. So if, say, you buy BHP stock and put up $10,000, a $200,000 position with the leverage, and BHP shares go up 10%, you double your money. If it goes the other way, you can lose 200% of the money that you put up. And a lot of people don't realise that. Now, these contracts for difference have been marketed on primetime TV and drawn in a lot of ordinary punters. There's estimated 35,000 to 50,000 people. ASIC is releasing a report on this next week, and they're very, very worried about the risks, and that's just one of the risks.
There's others too.
Yes, one of the risks is that the companies involved in this typically pool the money of the clients. People have a separate account, but your money can go to make up a shortfall in a position in another account, which is one of the things that happened at Sonray. And also, if a whole lot of people make money, you can effectively bust the bank and bring down the broker. So it's a higher risk position, probably not suitable to a lot of the retail investors who are getting into it.
We'll be interested to see that ASIC report. Thank you very much. See you next week.
You're welcome.